Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, and with me today, I'm happy to have my friend, Bill Chen. Bill is a managing partner at a institutional real estate fund. Bill, how's it going?
Great. Thank you for having me on. Appreciate it.
Hey, thanks for coming on. Let me start this podcast the way I do every podcast. First, a disclaimer to remind everyone that nothing on this podcast is investing advice. Please consult your own financial advisor, do your own work, all of that type of stuff. And then second, a pitch for you, my guests. I mean, the obvious pitch here would be to let listeners know that you are by far the best croquet player I know. I will take you over anyone on PinchWit. Bill gave me quite the beatdown last fall. But look, I've known you for a couple months. You're a great guy. You're a great investor in New York City real estate in particular. Maybe that's because, as you were telling me before, you've seen 100 different ways to lose money in New York real estate. But I've seen yourself. I know you do great due diligence on the companies you invest in. And for that reason, I'm really excited to go to the company we're going to talk about today. So that out the way, let's dive right in. The company we're going to talk about, I know this is a high conviction idea for you. It's FRP Holdings. The ticker is FRPH. And all of that out the way, turned over to you. What's so interesting about FRPH?
I think what's really interesting about FRPH is a good way to think about it is that there's a billionaire family and they own a collection of high quality hard assets. That works in an inflationary environment, that works in a deflationary environment, that you could buy today at, you pay $55 for it, it's probably worth 90. And, it is my personal opinion that it would be worth about 110 2 years out, right? And again, it's got a good collection of trophy asset. You could buy it at roughly 60 cents on a dollar. It probably grows. Call it 10% at its fair market value. So actually on a look-through basis, you're actually compounding at about 18% roughly, give or take. And then there's a huge kind of gain that you could potentially get from that gap closing, right? But just the fact that you're buying at 60 cents on a dollar and the end asset is growing at 10%, that gives you an 18% compounding. And I think that's really attractive. I think I'm a brick and mortar guy, so I get really into the assets and I kind of think about the public market, the private market, what the private market will pay for this collection of asset versus what you could buy in the public market. And frankly, any big REIT would love to own this collection of asset. Any big kind of family office that's managing more than $10 billion would love to own this collection of assets at the price today. And investors, this is one of the advantage of being public, right? Being a public investor is that you could own a collection of assets like this at a fraction of what it would cost in the private market, while the billionaire family, you get to tag along while they're doing all the heavy lifting for you. So that's what gets me real excited about it.
That was a great overview, because everything that I've got on my question list and everything, you basically hinted at there. So we're just going to be diving into everything you just went over in the overview. So let's start with the controlling shareholders. I don't think FRP is a REIT yet, right? They're just a normal public company. There's been talk of REIT conversion, but one of the things with big public companies with chunky real estate like holdings like this is you've really got to trust in the management team, right? Because a big building, it's going to throw off lots of cash flows. They're going to have to reinvest it. And it runs the gamut, right? We all know of public companies that have lots of real estate holdings and the money just goes into management's pocket one way or the other. Or there are real estate companies that compound value over time. So let's start with FRPH's management team. I know there's a really interesting history here of how they got to the current set of assets. Let's just go in the background there.
Sure, let's go into background a little bit. So the Baker family owns about 30% of shares outstanding. And who are the Baker family? So right before the financial crisis, in I think around 2006, Vulcan Materials approached a company called Florida Rock Industries. So Florida Rock Industries, FRP, hence the FRP Holdings, right? So the Baker family used to run the Florida Rock Industries. That was a multi-billion-dollar company. In 2006, housing was hot. They got approached by Vulcan. They got a bid, and they said, this bid is too good. We have fiduciary to our minority shareholders. We don't want to sell this, but it's not just us, even though they own a lot of Florida Rock Industries. They basically said we needed to do the right thing for our shareholders, and they sold the company to Vulcan Materials. So that was one instance where someone approached them with a bid. They weren't looking to sell. Someone approached them with a bid that they thought was very, very attractive, and they took the bid. The second time that happened was in 2018. Blackstone for the last 10 years has been basically approaching everyone who owns a warehouse portfolio that's more than 4 million square foot. Right? They've accumulated, I think, about 1 billion square foot at this point of warehouses.
Oh, I take it. I live in a 1-bedroom apartment in New York City. Yeah. I think if it was a 2-bedroom, they might have approached me about turning it into a warehouse and making a bid on
it. Yeah. So Blackstone approached them, and they went out and got an opinion from an investment bank, and they said, "Okay, we'll sell it to you, but it has to be the absolute highest end of our valuation." So if you look at the proxy that was filed when they sold the warehouse portfolio for $359 million to Blackstone in 2018, there's a lot of background of how much time it took them, about a year of going back and forth and negotiating, and they said. I think Blackstone originally approached them for $300 million. They're like, no, it has to be 359, and they got the deal done at 359. So this is a family, and we have a lot of conversation with them over time, where they've said that there's, given a high enough price, every asset is for sale, right? So there's a history of the family selling floor rock industries when they got approached by Vulcan, and it seems like that they're always selling when they're getting a really good price.
Yep.
So I think that takes away perhaps 90% of these quote unquote high insider ownership or controlling families for real estate companies, right? Because they could kind of treat it like, this is our family office, this is our family business, go away, we don't want to be bothered, right? And then if you look at also their G&A, right? The G&A runs about $6 million a year, and by my estimate, this pool of assets is about $700 million. So if you were going to give money to a private equity, real estate private equity, in that sense, you're paying no preferred, and you're getting, you're paying 80 basis point management fee, and you get daily liquidity, right? So again, I'm constantly looking at what can I get in private market and what can I get in public market. And in my opinion, this is a much better approach. This is a much cheaper, much better, and much cost-effective way to get this kind of high quality real estate exposure in the public market.
Fantastic. And I'm with you, right? Look, 80 basis points of, I hadn't thought of putting it like that, but 80 basis points annually of management fee, as you call it, versus, if you went to Blackstone and you took someone with this track record of 2 sales, maybe selling warehouses in 2018 wasn't the top of the market, but they got a very good price for it. That history, you'd be paying 2 and 20 in a heartbeat, right? So 80 basis points versus 2 and 20, that's great. Lots of places to go here, but again, this is a real estate company. So I think there are lots of interesting things to talk about here, but we don't have to make it too crazy complex, right? A real estate company it's a sum of the parts story. There's real estate, we need to value it. We can talk about interesting optionality, but I think the most important thing is share price is 55 right now. You mentioned NAV is around $90. Let's talk about what goes into the NAV to get to around $90 per share.
Sure. And I think, where do we start with the royalty business, right?
Great.
That's interesting. And this is probably the one of the harder assets to I think most real estate people could value a multifamily. They put a cap rate on it, right? They could put $1 per square foot on it. And the royalty is kind of a different beast. But, from my conversation with the Baker family over the years, we've owned this, since 2015, right? So we've gotten to know them very, very well, and they've been very, very candid in terms of feedback and whatnot. In essence, they said that given the choice of buying a multifamily or a warehouse, right, at 4.5 cap rate or whatever you want to call it, right, they would rather buy the royalty business at the same exact cap rate, on any given day. And why? Let's think about why, right? Aggregates. But before we get into any of it, if you look at the historical performance of this aggregate business, they had $200,000 of capex since 2006, right? And in that sense, I think they pulled out more than, at this point, probably somewhere around $100 million from 2006.
Hey, and Bill, can we just take a step back? Because I agree, it's a great business and they've got some slides and stuff, but I just wanted to define for listeners who haven't dug into the filings yet, what is the royalty business? What are the aggregate business?
Absolutely. Fantastic. So Peter Lynch, this goes to accumulation of knowledge, right? Like I found this couple because I read Peter Lynch's book, One Up on Wall Street, right? And Peter Lynch on One Up on Wall Street, like very bizarrely mentioned, the aggregate business is one of the best businesses out there, right? Because what is it? It's literally like you're buying a ton of sand, gravel, crushed stones, and it's worth next to nothing, right? Like there's like really no value for these assets, and that is the inherent moat of an aggregate business, right? Because it costs you probably $10 a ton for something that, it costs you $10 a ton, but if you want to ship it 50 miles, that the trucking cost is $10 a ton. So it forms like you kind of draw a circle, and within that radius, you have a ton of pricing power, right? And if you're that's why, like, if you're doing a construction project, say in New York City, you'll never go to Chicago to buy rock. It doesn't matter how good the rocks are. We actually won't even go to New Jersey, right? Because by the time you bring it over, it's going to cost you more to buy locally. So these are at worst local oligopolies, right? A lot of times, and the industry is very, very consolidated. There's more Marietta, and there's Vulcan, and then there's some players like CMAX and a few other French players, but they're local. At worst, local. They're either local monopolies or duopolies or local oligopolies. Local oligopolies are the worst that you could get.
Yep.
And the other thing is, there's a very strong NIMBY angle to this. It takes probably 5 or 6 years for you to get a permit approval, because let's face it, right? Like everyone loves that lovely neighborhood. They don't want a big rock quarry in their backyard and heavy trucks and noise, dust, and you got rocks falling off and like it's just like there's not a curb appeal. So we love investing in NIMBY assets. Because what it means is that basically your chance of new supply coming onto the market is very, very low. So typically, I mean, we've seen it where people sit on this waiting for the permit, and they'll go, they'll wait 5-10 years before permit is granted. So if you got a portfolio that's already cash flowing, that's already being mined, that's got a minimum 60-year life, that with 500 million tons of rocks of reserves, that's incredibly valuable.
And so FRP, they own these quarries, these are they own them, but correct me if I'm wrong, they don't really operate them, right? They'll lease them to, especially Vulcan. You mentioned they sold a lot of these to Vulcan in 2006, but some of the ones they still own, they'll lease it to Vulcan, and Vulcan basically just pays them pure profit. They get I think it's a percentage of sales or percentage of volumes mined.
Yep. So this is the other aspect. That why their specific business model is so beautiful. It's a pure top line royalty, right? They've never disclosed what the actual percentage is, but we estimate that it's about 10%. So 10% of top line. So there's no cost overrun. There's no like inflationary concern where your labor cost goes up or equipment cost goes up. If anything, inflation is so top of mind. This is probably one of the best assets to own, in my opinion, in an inflationary environment, right? Because inflation goes through. This is an asset that naturally has a lot of pricing power. They could usually increase prices by 3-4%, usually like CPI +2, right? So you could beat inflation, and there's no, like I said, I look back to 2006. I think there was like $200,000 of capex in the entire business. That threw off close to, I guess, like around $100 million of royalty income.
Yep, perfect. So as you said, this is a great business for inflation because especially what they own, they're just taking a percentage of the royalties. Local oligopoly, as you said, the rock, it's not very expensive to mine and sell, but if you want to transport it more than 50 miles or something, the transport costs are going to eat into all the costs. So you get nice pricing power and everything. Let's talk valuation, right? So great business. How do you look at the value of this? And I think this is one of 4 different pieces of value, just so people can keep that in mind as we do the sum of the parts. How do you look at valuing this business?
So I think if you look at, a company like this itself has kind of, in their Investor Day presentation, they have a great Investor Day presentation, and they have kind of said that, Moore, Marietta, and Vulcan are good comparables, right? And they use EV to EBITDA metric. But the reality with this is that I think you really should be using EV to EBIT, right? Because they have no CapEx, as opposed to Marietta and Vulcan has CapEx, right? So I think if you look at Marietta and Vulcan, I think they trade at over 20 times. which like if you invert that, that's about a 5% cap rate, right? So on a run rate basis, this royalty business is doing about $10 million in royalty income. Now, the reality is that all you're doing is you're sitting around collecting, a royalty check, right? They saddle it with a little bit of extra kind of G&A overhead, but if they were to sell it, this is probably a 98% EBIT margin type of business, right? So you could basically use the revenue as like your NOI.
You really just need one bean counter in there to make sure the checks are hitting the account. Really, right?
Exactly. So if you do 10 million divided by 5% cap rate, right? I mean, that gets you to about $200 million roughly, right? And now there's more to it, right? We just passed an infrastructure plan, right? And spending on infrastructure project is going to go up 20%. It's commonly expected that, on the investor day, they mentioned that you could probably see very large increases in pricing and about 5% increase in volume, right? And that will probably translate into the royalty revenue hitting about 12 million in the next 2 years. So if you go out 2 years, 12 million on a 5 cap, now you're in that, I think you're in a 240 range, right? Like you're in a 240 range. But there's more to this business, right? There's more to this business. There's a terminal value component to this, right? Let's take a step back. 5% cap rate, like, is that appropriate? Well, there's a 60-year life. There's a 60-year life, right? When you DCF out, right? It like, if you run the DCF with like a 4% price increase and a 5% initial yield, like that's a very, very reasonable, because you're actually getting probably like a 9% return on asset by owning this, by holding on to it for 60 years. And like, we get really technical, it's probably worth it's probably got a 100-year life, because as you dig down, you tend to find more rocks. Like, from a county perspective, you can't really report it, right? But typically when you dig down, you find more rocks, right? There's probably a 100-year life there. Now there's a little more, because they own all the land. When the mining gets completed, they own all the land. And what's super interesting is that they own a site down in Florida, in Fort Myers, where this, so big picture, they own 19,000 acres of land in Georgia and Florida. And being a real estate nerd, like, I've actually physically seen all these rock quarries in person, right?
I've seen the pictures of you at them. He's not lying. I've seen the pictures of Bill out there with hard hats.
So what's interesting is that there is a parcel of land in Fort Myers where they're going to dig down, and then this area is going to fill with this turquoise blue water. And it's been zoned for 101 luxury waterfront, lakefront. Like it's the best business that I come upon, right? Because someone's paying you to dig out the rock and create an artificial lake for you. And then you now can sell the lakefront lots, right? Like, I don't know a better business than that, right? And, what we see on Zillow is that land lots down in that neck of the woods would go for probably, we've seen on a 1 acre lot, probably $1.5 million, right, today. And you figure, but they won't be able to sell it till 2028. So if you DCF that back at 12%, right, with like little 3% annual price increases on it, that gets us to about $60 million for that. What we should be able to get about $130 million in 2028, right?
Yep.
And that's something that there's another kind of call at 4,000 acres in Brooksville, which a few years ago was probably a depressed area, but with Florida being so hot, like it's about an hour north of Tampa. I mean, that could potentially become like a housing development, right? And we valued that at 20 million. I think that's just like a little bit further away, right? So I think if you add everything up, like you get to a high 200s, high 200s, like right around that 300 million. But what's important to understand about this asset is that we've owned this company since 2015, right? Every year we sit down to do evaluation. We're like, oh, yeah, they took more rocks out of the ground. They took like another 6 million or 8 million and like tons of rocks out of the ground, but like the values actually increased, right?
Mm-hmm.
Because of that pricing power, because that ability to keep pushing 4% CPI plus 2. And this is an asset that took us a really, really long time to like understand. But this is, you know, I'm starting to see the world the way they view it, that you know, between a multifamily and this, like I'd rather own this. And you get in the long run exposure to Georgia and Florida, like, you know, where demographics and you know, you got all the right trends going for you.
That can be one of the most fun things about following a company for a while, where there's like one segment or one thing they do where you're like, oh, I just wish they wouldn't do this, or I wish they do something else. The company tells you, no, you're going to love this. It's going to be so good. And sometimes 3 years later, you look back and you're like, God damn it, why did those people keep doing that? That was so dumb. But I love it when it comes this way, where it's like, no, they were right. This is better. But just to put those numbers in perspective. So right now, about $55 per share price for the whole company. You mentioned on the very low end, the first number you threw out was 200 million. And then as you started throwing in some more things, I think you said a $300 million. There are a little under 10 million shares outstanding. So we'll just round up and call it 10. But so on the lowest end, this side of the business is worth $20 per share. On the higher end, it would be pushing over $30 per share. So that's serious numbers, right? We've only talked about this one segment, and we've already got somewhere between 40%, over 40% to over 50% of the value of the company done. I think that's good on the royalty business. The second part, I'm just going to throw out, the company, they have no recourse debt. They do have debt, but it's all at the property level, not at the company level. They've got $170 million or so of cash, 160, 170. I'll do the math for you. 10 million shares are under outstanding. That's about $17 per share. Do you want to say anything else on the cash? Because we will come back to it later when we discuss.
No, man, nothing really. I mean, I think one of your questions is like the opportunity cost of the cash, right?
Well, let's come to that later, because I want to establish some of the parts, and I just wanted to jump through the cash, because you add that to the royalty business, and now we're talking like, hey, we're at least $40 per share of value, and we haven't even talked about the things that I think most real estate investors know this company for and get excited about. So let's dive into that. They've got a lot of real estate projects, asset management, JV. Let's talk about the last pieces of some of the parts here.
Sure. So I think and this is a little bit hard to do verbally. You know, I think if you look at some of the photos, you know, they own a few multifamily projects, most of it in Washington, D.C., in an area by the National Baseball Stadium. And it's hold on a second. So they own 8 multifamily assets, right? And the way to think about it is that there's a DC waterfront play, right? So Washington, D.C. kind of revitalized the baseball area. That was kind of like a very rundown industrial area. And there's a lot of both private and public capital that went into it. And there was a company called Four City Enterprise that built out a big kind of mixed-use multifamily office that got bought by Brookfield, right? And where their asset sits is they sit on the water between the Anacostia River and the Washington National Baseball Stadium. So inherently, like Buffett talks about moats all the time, right? They're like, oh, you want to own businesses with a moat. It's like what is a physical moat? A physical moat is a body of water, right, where people can't attack you, right? In the real estate business, a moat is some sort of geographic constraint, right? Where people can't build anymore, right? So if you're right on the edge of the water, you got a real moat because they can't build anymore. Like you got the river view, right? And that's what gets me real excited about the location, right? Like you're in this up and coming, it's not up and coming anymore, because it's already like one of the one of the favorite neighborhoods in Washington, D.C. And what makes it really cool is that you got this river walk down there. You got an entire kind of park, outdoor park. You're about a 15-20 minute walk to Capitol Hill. So you like there's, if you look at the staffing, right, like a lot of people who live in that area, is there 15% I think is like military. There's like, if you watch NCIS, like on the outside, like that's right next to there, right? You got Capitol Hill. A lot of people are lobbyists who live in these buildings. You got a lot of Big Four accounting people, folks who live there, and those categories are about half of the residents. And what's most impressive about this asset, right? People talk about, okay, like why don't we stress test this? Like how bad did it get, right? Like during COVID, Doc 79, which is one of the buildings on the water there, their occupancy was basically only down about 1%, and they kept rent flat, right? Like, it is one of the most impressive for an urban location. That's one of the most impressive performance that I've seen. And we really added to our position when we saw that. And then if you look at the Marin, which is a new building right next door, they went from 0 to 45% lease in 2021. In doing Q2, right? Like, it was literally leasing up with people using iPhones to live, kind of give people live tours through iPhones.
It's easy to forget. I mean, Q2 is that was right before the vaccine roll up really got going, right? Like, by July, people thought that we were going back to normal, and then Delta and Omicron came back. But Q2, I mean, that is right at the start of the vaccine days. So that was still a very tough time. In New York City, I know you know New York City well, that was the end of, hey, get 4 months free on a 1-year lease in New York City. April and May was right at the end. So for them to go 0-45 is pretty impressive.
But I think you're thinking April of 21. This is April of 2020.
Oh, it was April of 2020. Oh,
yeah.
Then that is way, way worse. My bad. I thought it was.
There's no clarity. There was no clarity. They went from 0 to 45 in Q2, like when we were just locking down. Like if you think about, if you want to lease a multifamily in an urban location, like this was like not the time, and they got 45% lease in 1 quarter. I mean, that was.
I completely misread the investor presentation. That's way more impressive than I was. You know what? I think it was, I had a mental block that there's no way anybody could rent out a multifamily in April of 2020. That's probably it.
Yeah. So, I mean, it's like, I think if you start with the worst case and you work backward, you say, how bad could it get, right?
Yeah.
Like, this is the worst it could get. And they have this type of performance. So I think in this category, Dock 79, the Marin, it's kind of easy to value, right? Like the Marin, when it stabilized, there was a press release that basically said it valued at $150 million, and then you could kind of like work through the $88 million of mortgage debt, and like arrive at a value. Dock 79 would generally use a $7.3 million value, NOI. Like that's what we think when we kind of normalize, like what that would be, and our cap rate assumption is about 4.25, right? Like most multifamily in the U.S. trade in a 4 handle, with the Sunbelt being in the 3s, right? And this is, these buildings were built in 16 and 20, right? So these are brand new, like trophy Class A, like great location, waterfront, right? So between these two buildings, we get to about $98 million, like call it $96-97 million of equity value for those two buildings alone, right? And then there's 2 more land parcels right next to it that they could build. We value that at about $51 million. And there's a lot of comps, like, we've done a lot of digging where there's land transactions sold in those areas that were away from the water. And they're generally, we're valuing those at, call it, $85 a square foot. And those were from years ago, right? Like as a neighborhood gets further built out, the value increases, and we're using the comp further away from the river, right? So we think that's very reasonable. And then there's 1800 Half Street and Bryan Street. We value that at 38 and call it like $59 million. And that's very simple. We're just using book value. Now, when you think about a real estate development, as you pour the foundation, as you build it out, as you stabilize and do the interior and lease it up, right? Like the value actually gets created on a daily, weekly, monthly basis, right? But because of GAAP accounting, you basically say it is worth, like it is worth this initial book value. And then there's a quarter where they'll issue a press release and say, oh, you created, you double your equity value in this development project, right? And that all happens once. And that's what happened with the Marin, right? The Marin, I think during Q1 and Q2 of 21, when it stabilized, they came out with a big press release that says either $40-50 million of GAAP net income, and you got to adjust it for like the joint venture value, right? But nonetheless, what I'm getting at is that there's a big headline, there's a big press release that's going to say, there's a big GAAP income, a big step up. And what that is supposed to convey is that that's how much value they created through the development process. And they usually get that value from a bank appraisal when they put a permanent mortgage on it, right? Yeah.
No, that was gonna be my question. So where you're getting those equity values, it's not like they're pulling them out of nowhere. It's either, hey, we sold a piece of this to a JV partner, and this is the equity value that they valued at, or more likely, hey, it's on our books for 80 million, but we just went and took out a $140 million loan on this thing because it was appraised at 200 million or something, is where you're pulling these numbers on the developed properties.
So I'm pulling on the development projects. I'm literally pulling them from the 10Q, and it's historical costs. It's historical costs from, I guess, like for these two projects. These projects are like 2 years in, 2.5 years in, and they're in lease up. I talk a little. So I'll talk about catalysts a little bit, but I'll go through it. They got a project down in Greenville, South Carolina. So now you're in like more Sunbelt territory, and those projects should do really, really well. So if I aggregated, all those assets, right? I got about a $297 million equity value in that bucket, right? And this is net of debt and net of JV interest, right? Like, there's a lot of like, so let's talk about like, so you do 296 divided by, it's actually 9.5 million shares that I use. If you call
I was rounding up, Bill. Come on, I was making the math easy.
We make math easy. So you're talking about like $30 a share in the multifamily, and this is probably one of the best portfolios because it's waterfront. It's it's in like this really exciting neighborhood in DC, right? And like someone like Brookfield Blackstone would be like a very natural buyer, or like an Avalon Bay,
An insurance company buying already leased up multifamily. So I think that's great. So let's just pause right here. So some of the parts, right? Yep. We've got $17 per share in net cash on the balance sheet, no recourse debt. So there's $17 per share-ish. Then we've got, call it $30 per share in the royalty business that we mentioned earlier. If you include the value of the Fort Myers land and everything, let's call it $30 there. And then a little bit around $30 as well in the multifamily. So we've got 30 plus 30 plus 17, if I'm doing my math right on the fly, that's 77. And I was probably conservative because I was using 10 instead of 9.5. And then there's probably another 100 million of miscellaneous, office, warehouses and stuff. I don't think there's anything too chunky in there that we need to dive into. But again, that's another $10 per share. Add it all together, that's 87. Again, I was using 10 instead of 9.5. So we're at your 90. Is that about right at that point?
Yeah, no, that's about right. And I think one thing you may want to just take away from is that they do have some deferred income taxes, as you sell real estate. And what they've done is they've done a really good job either using 1031 exchanges or investing in opportunity zones to defer those taxes, right? So I think the actual report, the book value is something in the $50-60 million range, but like you're not really going to pay it today. And the opportunity zone has a lot of advantages where if you hold it for 10 years, you kind of almost indefinitely defer them. So I NPV it and I call it 25 million, right? So you probably want to take away $2.50 away from it, And I think like we're in the right ballpark. Like I have in my model about an $89 value, cohort. Like we're in the right ballpark.
And look, if it's 86 versus 90, the share price is 55, so that's fine. So let me get into my pushbacks here, right? Like I think this is great because the thing that jumps out at me, it's really hard to, people talk about the pre-mortems, right? Where you kill an investment before you invest. It's really hard to see how you do too poorly here, right? You've got a management team that seems committed to shareholder value, that's done well over time. They're not raking their pockets with fees. $17 per share of net cash on the balance sheet. That gives you a long way for downside protection. DC already leased apartment buildings. Like this is a great asset portfolio. So it's tough to kill yourself on the downside. But the things I worry about here are things like, first, opportunity costs, right? Okay. I worry that this is an investment where 10 years from now, you and I you're beating me at croquet, or maybe I've gotten better and I'm beating you. But 10 years from now, we're out on the croquet fields and I say, oh, hey, how's FRPH doing? Say, oh, it's great. And NAV is at 180 now. It's at 140 or something, right? So that's not too bad, 2.5 over 10 years, but that's not outstanding. We didn't make any great alpha. So my first pushback would be just Are we really going to make a lot of alpha here, short of the you wake up in 3 months and they've decided to sell the whole company thing?
Sure. I mean, I think that so what's important to let's talk about catalyst, right? Like why may the gap close? And I think that the way that so a couple of things. Let's talk about catalyst and let's talk about their track record. And I think the track record is also real important item to talk about, right? I, I think that if you look at how they've allocated capital since call it 2015, when we started owning this company, every project that they've done, they have achieved, by my estimate, 20% IRRs or higher. Okay, they that applies to multifamily development, that applies to warehouse development, that applies to opportunistic residential home building lot development, where they're getting 20% IRRs on those projects as well, right? So I think when you, and they're very selective, right? Like the process is that they've seen 800 deals. The last time I talked with them is that they've seen 800 deals and they've only invested about a handful of them. And that was since they sold the portfolio to Blackstone, right? So I think that's really key, because if you're invested with a family where they could get you 20% IR on the capital that they do deploy, right? They're very conservative, very selective, but when they do put capital to work, you're getting 20% IR on it, right? I would say that I'm willing to bet that over time, people will start to agree with me because of that track record, right? Like if we're talking 5 years from now, I think people will see a lot of these assets stabilize, and there's also a on the capital side, there's a resource conversion, right? I think it was Marty Whitman who coined the term resource conversion, right? Like you take land that's not just thrown off any cash flow, you put a building on it, right? Now it throws off, call it like $7 or $8 million of net operating income, and you put some debt on it, right? Like you could get $5 million, and where like even as soon as 2 years from now, like if we fast forward year end next year, right? Year end 2023. By my estimate, I think they could do $35 million of FFO, or operating cash flow, right? And most REITs, most high quality, multifamily REITs trade at 25, 30 times FFO. And that's just, you could pull up like, the big industrial REITs, the big multifamily REITs, like a high quality REIT will trade at 25, 30 times FFO multiple, right? So in the short term, there's that catalyst potentially working for you, right? In that, I like to own these assets when it's hidden land value that doesn't throw off any cash flow, and over the course of 3 years, it gets converted into cash flow, and then people could put a multiple on it and say, oh yeah, well, this is really obviously cheap, right? So I think that's one of the mechanisms, right? The other angle is that you mentioned the opportunity cost of $170 million of cash, right? They're putting that to work, and part of the reason why they have this cash is because they're so good at these developments. When they do a development project, that sometimes they'll finance it with both equity and preferred, and when it gets stabilized, they get that preferred back. Now they got more cash on the balance sheet, right? But they recently identified a couple of projects that. So remember, why this is a company that has its roots in warehouse development, right? They built up this warehouse portfolio from nothing to 4 million square foot and sold it to Blackstone. So they recently gained, they have the rights to about 2 million square foot of warehouse. So you figure to develop, usually buy the land. I think what they've been buying it for about $10, $15 a square foot, right? But it's actually worth $20 to $30 a square foot, but will cost them probably another $90 to kind of build the shell, build the foundation, and get that lease. So there will be a very productive use to that capital, and they'll probably do 40% return on asset on that deployment into the warehouse space.
No, that's perfect. That was actually going to be my next question on how they deploy cash. So let me just ask two questions on the warehouse space. So obviously the first sale of the warehouse they did from kind of 2010 to 2015 and sold to Blackstone, that was great. Do you know what the IRR that they invested, that they kind of realized on that portfolio was?
Sure. I mean, I think the cost basis was about 100. 80 mil, like somewhere in that 180 to 200 million, and they sold it for 359, right? And a lot of it was built. Now, keep in mind, they're also collecting. I think was doing about $21 million net operating income when they sold it, right? So they were getting $20 million of cash flow every single year, and they sold it for essentially double what they pay for. And if you do the IR on something like that, you're like in the teens. And the thing is, these guys, the family doesn't really use a lot of leverage, right? Like, have they used a lot of leverage? Like, we probably have an IR, like lever IR in the 20s, right?
If Bill and Andrew's optimally leveraged, optimally financed shop had done what they did, we would have been in the 30% IRRs. No, that's great. So, second question: this warehouse portfolio that they're about to build out. You mentioned, hey, they got the land for about $10 per square foot. You think the land's worth $20 per square foot, and they're going to go build it out, $90 per square foot of cost, but they'll build it out, and I'm sure at the end it'll be very successful, as most stuff they did. I mean, my pushback there would be, all right, these guys have been great at developing, but it's not like the warehouse game is exactly a secret at this point. Like, who's selling to them for $10 a square foot when there's a warehouse play at this point? How are they getting access to this great deal?
Fantastic question. And this is where I think that think about like their experience and where they have a lot of knowledge, right? They're like very in the DC, Maryland, like in the Middle Atlantic area. That's their backyard, right? That's where they have a real edge. And they're, historically, from a corporate perspective, they built 4 million square foot. Now everyone's looking to do warehouses, right? Because that's like one of the hottest asset class. The reality is that when you buy something for $10 a square foot, you got to take the time to get that entitled and get that, get that approved, get that ready to build, right? And that entitlement process, remember going back to the $6 million GNA, right? That's what you're paying these guys for, right? What you're paying these guys for is that anyone could buy a parcel of land, but to get it shovel ready, there's a value creation process. And that's part of it. Like it's like, why'd you buy it at 10? I think one, they found a good deal, but like maybe someone else may have to pay $15, $20 a square foot, but to take it through entitlement, there's a time component, and then there's a cost component to it, where I mean, frankly, when I spoke with them, they think that if you got shovel ready land in the Mid-Atlantic right now, it's probably $35, $40 a square foot.
Yeah.
I mean, that's, we own another warehouse company, so we're very like, in tune with like what land costs, what construction costs, like what rent is in each market. So this is a market where if I remember correctly, I think for brand new Class A warehouse, you're getting $7 a square foot net, right? So if you could buy land at $10, take it through entitlement and build, the shell for $90, like you're building to a 7% cap rate, and warehouse cap rate is probably, in that market, like 4.25 today, so like you're creating a ton of value. By developing these warehouses.
Well, let me ask the next question. You mentioned earlier the private market valuation versus public market valuation, and people go look. I put this in my notes. Like, I can point to a lot of REITs where I think they would say, "Hey, our private market value is a lot higher than our public market value." And the one I put in the notes was SL Green, which is all New York City. Now, that's New York City, which has its own unique things, but they've been saying it for a year. They've been pointing out, hey, like, our NAV is way higher than our stock price. They buy back shares pretty aggressively. They have slides. They say, look, we've been saying this for years, and every time, like, this is not some illusory thing. We actually sell assets at or above our NAV. There are lots of comps where the building next door sells to us for a 3% cap rate, and our NAV has our building at a 3.5% cap rate. So they've been saying something similar for years, right? And it's actually kind of, I think it's along the same lines. I think they say their NAV is like 115 and their stock 70, which is kind of the same as you say NAV here is 90 and FRPH is 55. So I guess my two questions here are, again, opportunity cost. Why FRPH over one of the many other REITs that are trading at a discount to private market value? And then the second thing is, just as an investor, whenever I look at these things, I'm like, I get it. Like I can see, and not just FRPH, SLG, Vernado, all these guys, I can see that the private market comps are a lot higher than public market. But I just say, like, what is the public market missing? Public markets are smart. They're not going to discount a whole sector for no reason. Is it just like they think cap rates are unsustainable? Is there something else they're missing?
Well, I think so. So that's a great question, and obviously this is something that I pay a lot of attention to in my pre-mortem analysis, right? And I think so. In the case of Vornado and SL Green, I think specifically it has to do with that. These are office assets, right? And if you look at the last 10 years, kind of rent growth, what you have to pay in terms of concession and leasing commissions and TI to like get an office leased up in New York City, what the actual owners keep hasn't really gone up a lot, right? Like it's just been a very challenging. And then you got COVID and this whole work from home. I think so a better way to think about it is terminal value is extremely important in real estate because you're naturally buying assets at call it like 20 times cash flow, right? So if there's any sorts of doubt on terminal value risk, right, automatically it kind of doesn't work. People may not want to own that, right? So like let's kind of walk through this. What gets me really excited about FRP is let's think you got an infrastructure bill, right, for the next 5 years that's going to result in strong demand for aggregates, right? And then the other thing is how would you impair 14 sites in Georgia and Florida of aggregate royalty business? It's like try to nuke that, right?
If you wanted to get really crazy, like one of the recent podcasts I had Vadim on and we talked BFIT, and one of his things was, hey, there are gyms and there's an out there risk where we all go into the metaverse or we invent a pill that you take once a day and gets you super fit. I mean, we could invent a risk here where Georgia and Florida's underwater 5 years from now from global warming or something, right? Now that's crazy, but you could invent some really strange risk. One thing, my wife always talks like, oh, we should buy real estate. And sometimes, or we should buy an apartment. Sometimes like, yeah, we should, let's get our rent payment out of here. But other times like, well, it sounds nice when you've been in New York City and you're riding the 80s to 2020 boom. But if you did Detroit real estate from 80s to 2020, I don't think anybody thought Detroit was like going downhill at the time, but it wouldn't have been great. So I don't know. I'm kind of rambling, but I definitely do hear you on that. I agree with you. Georgia and Florida have got a great future.
I think Georgia, Florida, I think given the, let's say for the next 10, 20 years in terms of kind of the tax regime, in terms of demographics, like where people are migrating to, the demand for home building, housing, affordability, I think you don't have any of that in New York City. Like, will people go back to the office? Like you just don't have any doubts, right? And I think that's a critical factor. And like, people have been pitching me, well, Bill, like Seritage is really cheap, right? And I've been pitched that name for the last 10 years. And it's been cheap on some of the parts. No, this is like super important. And I don't mean to like, talk negative about Seritage investors, but I think.
I'm just laughing because I once every 2 years I look at Seritage on the same thing. I'm like, it looks cheap, but there's a lot of heavy lift in here. This is it's too hard, man.
Well, there's something to be said about owning an asset where you can sleep really well at night, right? You pay 5% cap rate for a 20 multiple, but you could wake up next year, wake up 5 years from now, you get 10 years from now, you're like, they got pricing power. This is not being impaired, right? Versus like retail, right? Like even 5 or 10 years ago, I had this conversation where people say, hey, Bill, like, what do you look at Seritage? It's so cheap on some part. I'm like, it interests me less when you're buying into a melting ice cube, right? Or a potential melting ice cube. And I don't think,
the older I get, Warren Buffett said, I think it was Buffett, time is the friend of the wonderful business and the enemy of the poor business. And it sounds so trite, but the older I get, those trite Warren Buffett sayings, they have so much. And I think one of the reasons buying good businesses, buying good assets like you are with FRPH versus probably, Seritage does have some good assets, but the nice thing is if you buy FRPH and it is a good business, and I think you've made a good case, like the value just keeps growing. So maybe your 55 to 90 gap doesn't close until they announce a deal 10 years from now, but guess what? The value just keeps growing over time. So as maybe the discount stays the same, but it just keeps going. And that's just such a nice tailwind to have behind you.
Yeah. Well, no, man, like going back to our original math, right? Like say it takes 10 years for you to close this gap, right? To, I don't know whether like investors actually pay NAV for like the actual private market value, or you get you get bought out or something, some sort of event happens. If you think the private market value could compound at 10% a year, right? And why 10%? Usually when you put leverage, usually when you put mortgages on a multifamily asset, right, you could usually get to about a 10% lever IR. That's usually from my experience. I mean, that's why pension funds, endowments, the big insurance companies, they all love these multifamily assets, right? Because when you put 50% mortgages on it with like 3.5% debt on it, and you get like 2-3% rent increases, you could get to a 10% lever IR on it,
Yep.
right? So the agribusiness, you get a 5% yield, you get like a 4% price increase, you get to around a 9% return on that without the use of any leverage, right? And then any sorts of development that they do in the other bucket, they tend to hit, 15-20% IR. The only project that they haven't done well is this kind of like mixed use retail / office asset, and that's been a little slow to lease up, but that's like 1% of the AUM. I mean, other than that, I mean, all their projects since 2015 has been home runs. And I think that's the aspect that the market doesn't necessarily appreciate, right? And I just kind of look at it and I say, I kind of look at FRP in my portfolio, like why do I own it? Like I kind of view it as drafting like a really good offensive lineman, right? Like they're not like this is a position that's where you're like you draft a really good left tackle, like someone like Joe Thomas of the Cleveland Browns, and you're like he's got to create a lot of value for you for the next 10 years.
Hey,
right?
How can you argue with the last 10 years of Cleveland Brown football results, Bill? Come on. You can't bring the Cleveland Browns up here.
Well, I'm talking specifically about Joe Thomas, who never miss a snap.
I agree. This is one of those ones. I mean, I'm just getting bullets as we go through the podcast, but it's almost like everything you look at. It's the same way I view Charter in my portfolio. Like everything you look at, I think Charter can do mid double digits IRR pretty easy for the next couple of years. Like I feel so confident in the terminal value. Everything I look at, it has to be compared to buying more Charter. And for you, I'm sure it's the same way like FRPH.
Exactly.
I'm getting it at a 40% discount to NAV. The NAV is going to grow 10%. There's no recourse debt. So it's really hard to get, anything you're going to do, that's sleep at night, double digit IRR. Like it's tough to beat that. Let me ask you, I've got 2 more questions here.
Yeah.
First, as you know, I share repurchase. I'm just obsessed with share repurchases. I love share repurchases. And I always find it interesting when a company goes from aggressive share repurchases to slowing share repurchases. And the company, I tweeted this out, they said, hey, in 2020, we did a really nice job buying shares back. Our stock was screaming cheap and we took advantage. And I think they retired about 5% of their shares outstanding. I'd have to check my math, but they did a nice job buying back shares. They're not really buying back shares today, despite the undervaluation we've discussed, a great balance sheet, no recourse debt. They say, hey, we're not really buying back shares. And that's fine. They've got some projects. We talked about the warehouse projects that can deliver solid IRRs, but it does strike me as interesting. If the company isn't buying back shares and their history is when they're undervalued, they buy pretty aggressively, why should I be buying shares today? Does that make sense?
Yeah, no, absolutely. I mean, that's a very valid. And this is something that took me a really long time to kind of like understand the nuance of this, right? So first of all, like, not every company is like a John Malone share buyback optimizer, right? And I, my understanding is that if you look at the higher range of previous share buybacks, it's in the high 40s, right? So you could make an argument that if you, at $55, right, like you could potentially where they will start buying back share will probably be a $49, like a high 4 handle, right? Is where, so you're maybe 10% off. So that's just another reference point. In terms of like, why not? I think that, like people say, yeah, there's so many companies out there trading at a sum of parts discount, right? Like, why own this one, right? They're trying to solve that problem, right? It's like, I think sometimes shareholders could kind of be like, oh, like why would I want to own it? I think what they're trying to do, I think they have a board with some really competent people on it who basically told them, well, you know what, like for you to get fair value, you need to convert these assets into cash flowing assets so that in the long run, Wall Street could, put a cap rate or put an FFO multiple on it, and you will trade to full value. And, another company that we own is a company called Griffin Industrial, and which is now converted into Indus Realty Trust, right? And Gabelli owns a lot of that company. I spoke to Mario Bao at a conference very briefly, Gabelli was very public about asking them to buy back shares, right? If you look at what happened with that company, had they bought back more shares, they would have owned a lot of land in Connecticut with like very little cash flow, right? That market would not care about. But instead, they pivoted into Lehigh Valley. They went into Charlotte. They sold land in Hartford, Connecticut, and they used 1031. They went diversified, went into other market. Now they're a warehouse platform, right? I think when it comes to real estate, there are really unique traits in terms of like how do you. This is what I think about daily, right? Like you mentioned, Charter. Charter is a deeply liquid stock where you could wake up on any given day, you could buy back as many shares as you want, right? There is a trading liquidity, right? And I think like how you solve that, how you close that gap in the long run is you go about the route of resource conversion, right? You convert your land into cash flow and assets that the market could put a cap rate on or multiple on, and then you build up enough of it and then it brings in enough investors. If you buy back shares, you actually further creates that illiquidity problem, right? Like as a value investor, you're like, yeah, but like if you're at a discount, just buy back, you create so much more value. The reality, like at the same time, like if someone who's big want to buy, build a $10 million position, it's gonna take them really, really long time. I think there really is an element, and 10 years ago, I would have said, that's hogwash, like, I don't care, right? But trading liquidity and who could own the stock actually makes a huge difference in terms of the discount that you trade at.
Yeah, no, I 100% agree. And as you're saying here, like as we're talking, it's almost the end of the trading day. The stock's traded 3,000 shares, right? So that's 55 shares. I'll make the math easy on myself. We're talking $150,000 of trading value. Like, yeah, it'd be nice if they were buying back shares at this discount, but they can't buy back all of the shares, right? So it's going to be a drop in the bucket, for these companies. I'm with you. 5 years ago, I would have said, screw that. They need to buy back shares. And today I'm like, well, look, there are dynamics behind this. I'm sure they're trying to create value. And honestly, with that trading volume, it might not even be worth the headache to try to retire shares versus, hey, let's go do 20% IRRs to build out the next great warehouse platform, and we'll sell it again to Blackstone in 2024 and make a huge premium or something. Last thing, I said a couple times, one of the nice things here is great DC multifamily assets, right? $17 per share in cash on the balance sheet. I think pretty inflation resistant. Everybody's talking about inflation these days. You've got the rot quarters. Multifamily should be pretty inflation resistant because your leases are turning over about every year and everything. What kills you here? What keeps you up at night when you're investing in FRPH? What am I missing as a big risk here?
I think that like we talk about, like this continuing to trade at a big discount to NAV, right? Like if this perpetually trades at a 60% discount to NAV, then you may, then like your return is actually lower, right? So that's one concern. I tend to think,
that doesn't kill you. That just,
you're talking about like fundamentally, right?
Yeah, that's just, hey, I'd like to do 15% annually per year, but I ended up doing 8%, right? It's not the end of the world. It's not great, but it's not the end of the world. But it sounds like to me, you're saying it's tough to see something that kills you.
It's tough. My lawyers may tell me to say differently.
I'll throw one more.
Yeah.
Lots of people have said real estate, one of the reasons it's been such a great asset over the past 30 years is interest rates went from 15 to 0 or something, right? You even said when you were talking about the math behind them building warehouses, if I remember correctly, they build it and basically the all-in math, they can build it to about a 7 or 8% cap rate, but warehouses are worth about a 4% cap rate. And I'm just making, so they've built it real cheap. I do wonder, interest rates, we get 7 hikes this year or something. Interest rates are fundamental gravity going up to 4%, right? Cap rates go from 4 to 6.5%. All of a sudden, these warehouses that we thought they were building really accretively, they've basically built value neutral, and there's not that much margin of safety there, where if interest rates were a little higher or cap rates were a little higher for some reason, they actually built at a loss. Do you worry that so much of, I hate to say this because again,
Yeah.
interest rates higher, inflation's higher, so the multifamily probably does good, the quarries does good. But do you worry that some of it is just interest rates are so low that almost any build out looks good right now?
Yeah, I mean I think that's a great question, right? Like, and frankly, that's a question that a lot of investors that are 50 and younger, right, or maybe like definitely 40 and younger, like never have to deal with, right? Like we've been since the 80s, we've been in a declining interest rate environment, right? And it's something that I'm very very cognizant of. So let's walk through the mechanism, right? I think when you have rising interest rate where it kills you, and this is what I saw at Citigroup a lot, right? Usually you get into a lot of trouble um, if you get a mark to market, it is not as bad. If you get a sudden need to repay the principal, that's when you get into a lot of trouble, right? Um, and um, and I think that if you look at how they're financing it, like Doc 79 Maryland has 12-year fixed rate, 3% interest, right? You could say if interest rates go up to 5% tomorrow, right? On a mark-to-market basis, you may say, oh, that's worth a lot less now, right? I think the mitigant is that you don't have to deal with that balloon payment until 12 years from now.
Yep.
And 12 years from now, if we're in a 5% interest rate environment, there's probably a pretty good chance you're able to go from 2 to 3% rent increase to 5 to 6% rent increase, right? Because it probably indicates like a highly inflationary environment. So I think when you pay like you got to pay attention to not just the terms of the debt is just as important as the interest rate. Now, we done an internal analysis where I think if you get to a 6% cap rate for the multifamily, and you put a 6% cap rate on the aggregate business, and kind of like impair everything else by 50%, you get roughly what the stock is trading at today.
Yep.
And I think like if you ask most private guys, like, would you want to buy trophy waterfront class A DC multifamily at a 6% cap rate? Like, I mean, I think there's going to be a lot of people like knocking down doors, like, looking to buy that. And
it reminds me of a lot of times I'll talk to someone else, say like, oh, this company, just to make it simple, trades for 8 times EBITDA and all the comps trade for 10 times EBITDA. And they'll say, and I think this company's slightly better, right? They'll say, oh, well, what if the comps trade down to 8 times EBITDA? And I think it sounds interesting as a pushback because the bear case always sounds more interesting, but the answer is, well, I'm already buying at 8. So everybody else is down 20% and I'm flat. And in your case, like the market has already priced this in at a 6% cap rate. So if everything comes to a 6% cap rate, well, we got cash in the meantime and we're break even. So again, it doesn't kill you. Anyway, we're running pretty long. So I just want to last thoughts on FRPH. I think we did a really nice job covering it, but anything we didn't cover, you wish we had hit? Anything you wish we had hit a little harder?
No, I mean, I think we did a pretty good job. I mean, maybe one last thing would be, I mean, there are ways to hedge out some of that interest rate and market exposure. Like, this is a smaller company. You could go 15-20% out of money, just buy puts in like an Avalon Bay or like a Prologis, or you could even buy 20% out of money puts in Mar Marriott and Vulcan, right? Like as part of risk management for my portfolio, like I just roll this. And if I
Bill's out here worried about giving advice, and then he's talking complex hedging strategies. No, I'm totally with you though. Like again, it comes to if you're buying something for 8x and all the peers are at 10x, like you could just take the market risk, or you can go hedge with peers. One thing I've looked at a lot with a lot of oil companies seem to imply like $55 oil in their stock price, but oil's at 90. There are ways to hedge that, right? So, and capture that spread. Again, that gets more complex. Everybody should do their own work, do their own diligence, but I'm definitely with you there. Anything else on FRPH?
No, I mean, I think we did a pretty good job covering it. And this has been a fantastic conversation. I've really enjoyed it.
Hey, I know you do great work. I saw all the photos of you with the hard hats here, but this has been even better just like diving in here. This is why I love the podcast, diving into these things. Bill Chen, great real estate investor. Thanks so much for coming on. We're going to have you back so you can tell everybody your New York City apartment thesis at some point, because that's a banger one as well.
Hey, maybe I do have to come back to talk about that one.
Bill, thanks so much for coming on, and we'll talk soon, buddy.
All right. Sounds good. Thanks.